Welcome to the Prosperity Health GP series. As accountants and financial advisors who specialise in the medical industry, we understand our clients are often time poor and not able to get to the office during business hours. For this reason, we've decided to put together a small video series specifically for GPs to help answer some of your frequent questions and help you run your business better and take control of your personal wealth. My name is Brendan Campbell. I'm from the business advisory team within Prosperity Health, and in this video I'm going to talk to you a little bit about debt structuring. Debt structuring is something that's easy to do, but often not done well. If it's done correctly, it can have significant advantages for you and your practice. Given the Medicare freeze, a lot of practices are finding the top line growth isn't where they'd like it to be this year and in future years coming. So they're looking more towards the expenses to see where they can reduce expenses and therefore increase their profit. One such expense is interest expense. In this video, I'm going to talk to you about good debt structuring and try and answer a few questions that we commonly get around this topic. First of all, I'm going to talk to you about what interest is tax deductible. Then we're going to look at the purpose of borrowing. And finally, we're going to look at some examples to see what makes interest tax deductible and what isn't tax deductible. Interest can be deductible for a number of reasons. It might be borrowing to buy an investment property. It could be borrowing to buy shares or something similar to that nature. We're actually looking a little bit more specifically today at borrowing in relation to businesses and business expenses and if that interest is tax deductible. Interest is deductible under Section 8.1 of the Income Tax Assessment Act of 97. As you can see from the infographic on your screen, second limb refers to interest being deductible as it's necessarily incurred in carrying on a business, gaining or producing assessable income. Therefore, if the debt relates to a business loan, then it will be deductible under the second limb of Section 8.1. Borrowing for business can be a variety of things. It might be borrowing for superannuation, for staff wages, for service fees, or just to pay your normal business expenses. And if that's the case, then if they're genuine expenses for the business, then that interest will be tax deductible. The second question I want to address is the purpose of the borrowing. Now, this isn't a question I often get asked, but it's something that should be asked more regularly because it's the purpose of the borrowing that makes the interest tax deductible. If you were to borrow $10,000 to pay some of those business expenses I mentioned earlier, then those business expenses are for the business and therefore that interest would be tax deductible. But it's important to understand the purpose of that borrowing to make sure that you are borrowing it for business expenses and that it's done correctly. One example is if you were to running a business and you had $10,000 worth of service fees to pay. Now keep in mind a contracting doctor is running a business if they're working at a practice as a consultant or contracting to that practice. If they were to borrow $10,000 to pay their service fees, then that interest on that borrowing would be tax deductible. Now in a second situation, you might have another doctor who works at the same practice. Now that doctor might be running a very similar situation. If they've spent all their money on paying their business expenses and then find they're a little bit short on funds for that month, and then they borrow $10,000 to top it up and transfer it out through drawing, say, or through a trust account, down to their personal funds, they've also borrowed $10,000, whereas the person in the first example has borrowed $10,000 specifically to pay for business expenses. The doctor in the second example has already paid their business expenses. So when they've borrowed their $10,000, it's essentially for private use because they've transferred it to them privately and they're going to use that money privately. Therefore, Doctor 2, the second doctor, wouldn't get a tax deduction for their borrowing. So as you can see, they're very similar examples and both of them are in the same sort of situation, but one of them, the first doctor, has structured their debt a little bit better and they've borrowed for the right purpose and they've borrowed for business debt. Neither of these doctors have higher debt than the other doctor, but the first doctor has deductible interest and the second doctor, unfortunately, does not have deductible interest. Therefore, as you can see, if you look at this and run it a little bit more streamlined and think about your debt a little bit better, you can find that in a similar situation, there's often a better result you can get just by structuring your debt a bit better. So that brings us to the third question. How big a difference can debt structuring make in your situation? It might not sound like much. This might sound like it's a lot of hassle to go through for not a lot of gain. And that might be the case. What we find though is that it does make a big difference and it can build up over time. Let's look at a little example we run. So Dr. Indiana Jones might be working at a practice and obviously a contracting doctor, as I said before, is then running a business and working at a practice. Dr. Indiana Jones, say, borrows $50,000 over the year to pay for his service fees. The borrowing for those service fees would then be for a deductible purpose and therefore the interest would, a business purpose, and the interest would be tax deductible. In this situation, the same doctor has a reasonably aggressive strategy in relation to trying to pay down his home loan. So when he gets his income from the practice, he's paying down as much as he can through, say, trust drawings, and structuring to get that right is important. is paying that down to his personal account to pay off his home loan as quick as he can. Coincidentally, that might be a similar sort of amount that he's paid to say $50,000 off his home loan, trying to get that down as quick as he can, and he's been left short in his business. So he's borrowed some money within the business to pay for some of those business expenses, like service fees. In this situation, his borrowing, say for a year, would be $50,000. Now over a year, let's assume say 5% interest. And if his home loan is at a similar rate, he's probably reduced his interest in his home loan by about $2,500 for the year, but he's also got interest in his business loan of about $2,500. But in this situation, the business borrowing is tax deductible, and therefore he's getting a tax deduction on that loan. Now, that might not sound like a lot of money, but if we extrapolate that over 5 years, all of a sudden the numbers start building up and building up and building up. And it works out to be a bit over 18 grand over 5 years in that example. Please note that this was an example that I used that was fabricated in a way just for this short video series. The example we used is very specific and has controlled variables where it's important to make sure the structuring is right, the personal affairs are right, and the tax advice is right. Not only just with the business borrowing, but the personal borrowing as well. So please don't try to do this yourselves. Please make sure you do seek professional advice in relation to this to make sure you get it done correctly, because as I said at the start of this video, it can make a significant difference, but you've got to make sure you're borrowing for the right purpose and doing it for the right reasons and be part of a genuine strategy for your business. So please seek advice when you can regarding this. Well, I hope you enjoyed this episode of the Prosperity Health GP video series. If you'd like to find out more, please go to our website at www.prosperityhealth.com.au. There you can find links to other videos in this series and also links to find an advisor in your area who can help with your situation.